Coming now to section 4, investment decision criteria, and this is the largest section in this reading. Analysts use several important criteria to evaluate capital investments. Some known metrics or some known methods are given right here: NPV, IRR, payback and discounted payback, profitability index, and AAR. We will talk about each of these. Let's start with NPV. We have seen this in quantitative methods, but we will cover it again over here. Net present value is the present value of the future after-tax cash flows minus the initial investment today. To come up with an NPV, we need a discount rate or a interest rate. Let's say in our example that is 10%. We are considering a project where we invest 100 today, and after 1 year we will make 10. After 2 years we make 10 again, and after 3 years we make 110. What is the NPV of this project? If you look at the definition, the net present value is the present value of the future after-tax cash flows minus the investment outlay. What is the present value of all these numbers? The present value of the cash flow at period 1 is 10 divided by 1.1 because we have a discount rate of 10%. The present value of the second cash flow is 10 over 1.1 squared because this cash flow is happening at the end of 2 years. The present value of the cash flow which happens after 3 years is 110 divided by 1.1 cubed. The sum of these three represents the present value of the future after-tax cash flows. From this, we subtract the initial outlay of 100, and when you put all these four numbers together, you have the NPV. If you do the calculation, what you will actually get is 0. This particular project has a NPV of 0, which means that the present value of the future cash flows is equal to the initial cost. If we had higher cash flows, then the NPV would be positive. If we had lower cash flows, then the NPV would be negative. This brings us to what's called the NPV decision rule. For independent projects, a positive NPV means that you should accept the project. Positive NPV means that if you consider all the future cash flows, their present value is greater than the cost or the initial outlay, and therefore it makes sense to accept the project. A negative NPV means that the present value of the future cash flows is less than your initial outlay, and there you clearly reject a project. What do you do for mutually exclusive projects? There clearly you accept the project with the higher NPV as long as the NPV is positive. Let us consider this example. You are given a cost of capital of 10%. Here is what you need to do. The initial cost is 1000, so you say minus 1000 plus 500 divided by 1.1 because 10% is the discount rate, so you do 1 plus 10%, which is 0.1, plus 400 divided by 1.1 squared plus 300 divided by 1.1 cubed plus 100 divided by 1.1 to the power of 4. You do the calculation and you will come up with the NPV, and you can use the same process for project B. As you can see, this is a very long-winded process, and if you start doing this on the exam, chances are that you will not finish on time. What you should do instead is learn how to use the calculator, and we've seen this in quantitative methods also. Therefore, you can consider this a review. Here are the keystrokes that you need to enter. You hit the cash flow button, which is right here, Second, clear work to make sure all the cash flow registers are cleared, and here is what you should then see. You enter 1000 plus minus. That is a way of saying that the first cash flow is minus 1000. Down arrow 500, enter. This sets the first cash flow to 500. Frequency 1, because the 500 is only happening once. You enter all the other cash flows, and then once all the cash flows have been entered, you hit the NPV button. The calculator will ask you for the interest rate. You plug in 10 and hit enter, and down arrow compute. You should get the NPV of 78.82. Make sure that you are very comfortable doing this. Practice coming up with the NPV for project B, and the answer is given on the previous slide. Next, internal rate of return, or IRR. IRR measures the return for a given project. Let me go back to a simple example that I discussed earlier. Let's say you invest 100 and then you get 10 at the end of year 1, 10 at the end of year 2, and 110 at the end of year 3. What is the IRR for this project? Notice that you are getting a 10% return. With 100 investment, you get 10, 10, and then 10 plus your 100 back. So clearly the return is 10%, which means that IRR is equal to 10%. What I have done here is illustrated the fundamental idea behind IRR, which is the fact that it is giving you a measure of return. The second bullet point gives you a slightly more complicated definition of IRR, which you also need to understand. IRR is the discount rate that makes the present value of the future cash flows equal to the investment outlay. Let us see how this statement works in the context of our example. What is the initial outlay? The initial outlay is 100. What is the present value of the future cash flows? That is equal to 10 divided by 1 plus R. The R is what we will be calculating. Plus 10 over 1 plus R squared plus 110 over 1 plus R cubed. The value of R, which makes the present value of the future cash flows equal to the initial investment, is the IRR. Notice that if you plug in 10% or 0.1 for R, you will actually get 100. So by plugging in, you recognize that the IRR is 0.1 or 10%. Clearly, this is very hard to do, and we are going to learn how to use the calculator, but the point of going through this exercise is to illustrate the fact that this statement does indeed hold true. Another way of expressing this statement is to say that IRR is the discount rate which makes NPV equal to 0. Notice that what I wrote here could also be written as follows: minus 100 plus 10 over 1 plus R plus 10 over 1 plus R squared plus 110 over 1 plus R cubed, and all this is equal to 0. What I've done on the right hand side is simply rewritten this expression. The left side of the equation is simply the NPV of the project. So the discount rate, which will make NPV equal to 0, is the IRR rate. Finally, what is the IRR decision rule? If the IRR is greater than the required rate of return, then accept the project. Simplistically, right now, think of the required rate of return as the return that you require, or think of it as the cost of raising money. In other words, if this $100 can be raised at a 8% rate, it costs you 8% to, say, borrow 100. Would you do a project which gives you a return of 10%? The answer is yes. If your IRR is greater than this required return of 8%, then you accept the project. On the other hand, if your required return was 12%, because it costs you 12% to raise your 100, then it does not make sense to do the project. And that's the second sub-bullet over here. If IRR is less than the required rate of return, then you should reject the project. What you are looking at here is the decision rule for independent projects. What about the IRR decision rule for mutually exclusive projects? What you do there is select the project with the higher IRR as long as the IRR is greater than the required rate of return. Let us consider this example. Given what you just learned, how would you come up with the IRR of project A and project B? Here is what you would do. This is the long-winded method. We said that the IRR is that rate which makes the present value of the future cash flows equal to the initial investment. The initial investment is 1,000. Present value of future cash flows would be 500 over 1 plus R plus 400 over 1 plus R squared plus 300 over 1 plus R cubed plus 100 over 1 plus R to the power of 4. This is extremely difficult to solve, and you might plug in some numbers for R to figure out which number will give you 1,000. But the best way to solve this problem is to use the calculator. For project A, you again enter the cash flow the way we entered cash flows for the NPV example. Here we do not enter any interest rate because the rate is what we are computing. So once you've entered all the cash flow, then hit IRR and compute, and the calculator gives you the IRR. Just once in your life, you can then go plug this rate into the long-winded formula and convince yourself that it works. For practice, I want you to compute the IRR for project B because you need to be very comfortable using the calculator. The answer you should get is 11.79%.